Housing and office markets around the world are tanking, and they're taking Blackstone down with them. The world's largest alternative asset manager, with $900 billion of assets under management, has now effectively defaulted on over $1 billion in debt. But Blackstone is playing it cool, pretending as if nothing were wrong. It's even launching a new fund to buy more real estate. But that fund may not be what it appears to be. In fact, Blackstone, which by some measures is the world's largest landlord, with $280 billion in real estate, is facing the biggest challenge of its 40-year existence. Everything about its business model, from the interest rates it pays on its debt to demand for office space and investor confidence, has been turned on its head. In this video, we'll run down exactly what's going on with Blackstone and why this financial giant may be in serious trouble. But before we go any further, make sure to hit the subscribe button to get alerts for our latest economic insights. And if you like this video, hit the like button and help us spread the word. Blackstone has become notorious in recent years for its controversial habit of buying up large amounts of single-family homes, turning them into rental properties. Community activists and municipal politicians have accused them of pushing people out of the homeowner market, forcing a growing share of the population to live as renters for life. We'll talk about this issue later in the video, because right now, Blackstone's housing investments aren't going the way it wanted them to. But first, we need to talk about commercial real estate, which is a much larger part of Blackstone's business, and that part is really in trouble. Up until several years ago, the office rental business was booming. The occupancy rate in U.S. office buildings was 95%, and interest rates were super low. That made it very cheap for Blackstone's real estate income trust, called Bright, to buy up office towers and rent them out. Then the pandemic hit, and everyone who could was now working from home. At the height of the pandemic lockdowns, the office occupancy rate plunged to just 10%. At first, commercial real estate investors weren't worried because they believed that once the pandemic was over, everything would go back to how it was before. But of course, that didn't happen. Working from home is becoming a permanent habit for many people. As of late 2022, the U.S. office occupancy rate was just 47%. Only about half of office workers have come back to working full-time in the office. This means many businesses aren't renting out spaces like they used to. Revenue from new leases was down 17.5% in 2022. And something else changed too. Inflation made a comeback. After several decades of lying dormant, inflation returned with a vengeance in 2021 and 2022, hitting its highest levels in 40 years. During the pandemic, the U.S. Federal Reserve and other central banks around the world began printing money by the hundreds of billions, flooding the financial market with new cash. Then, they dropped interest rates to rock-bottom levels. At first, this looked like a good thing. Stock markets, which had crashed at the start of the pandemic, recovered and kept on booming. All that fresh money allowed the U.S. and other governments to spend generously on income support for people and businesses. The world pulled through, without the sort of economic devastation that a pandemic would have otherwise caused. But then, prices began to rise. Supply chain disruptions during the lockdowns pushed up the costs of raw materials and shipping, which then spilled over into the cost of everything from food to cars to microchips. Fortunately, there was a ton of new cash floating around. It turned out that people and businesses could afford the higher prices, so businesses began raising prices even more. So employees started asking for more money, and before you knew it, we were in an inflationary spiral. By early 2022, the central banks had realized they'd made a mistake. They had overdone it on the money printing, so they scrambled to reverse course. Quantitative easing, as money printing is technically called, became quantitative tightening, and they started raising interest rates as well at the fastest pace in decades. This proved to be poison for Blackstone. To put it simply, high interest rates upended the firm's entire business model. Blackstone had made billions by buying up properties on cheap debt, then renting them out at a big profit margin. But now tenants weren't renting, and the cost of borrowing was on the rise. In this environment, things began to break. The first sign of trouble for Blackstone came last fall when its flagship real estate income trust, known as Bright, hit its redemption limit. So many investors were pulling their money out of the fund that Blackstone had to put a freeze on it. They blocked investors from pulling their money out of Blackstone funds. It was the investment fund equivalent of a bank run, and it's been going on ever since. For 5 straight months now, investors have been denied their money when they asked to cash out. In February, investors requested withdrawals of $3.9 billion, and in March they requested another $4.5 billion. But so far, Blackstone has only been allowing a fraction of those withdrawals. In March, it allowed only $666 million. And yes, Blackstone can simply deny investors' requests. It's written into every investor's contract that Blackstone can reject withdrawals, known as redemptions, if those redemptions hit a certain level. Blackstone limits redemptions to 5% of the fund's value per quarter. And while this has been going on, things have only been getting worse for Blackstone's real estate investments. In March, the company defaulted on a $562 million debt it held on a portfolio of office buildings it owns in Finland. Blackstone bought Finnish property company Sponda Oy in 2018, along with its portfolio of 45 properties, mostly office buildings, for €1.8 billion. These aren't top-of-the-line office buildings. Picture a dentist's office in a suburban strip mall. That's the kind of thing we're talking about here. These C-class offices don't rent out for much, and Sponda's portfolio has a vacancy rate of 45%. They're nearly half empty. And they didn't seem to be very good investments to begin with. Their vacancy rate back in 2018, when Blackstone bought them, was 35%. In the good old days of cheap debt, buying any office space you could find might have seemed like a good strategy for Blackstone. But now, all this indiscriminate buying has become an albatross around the company's neck. And since the Sponda default, news has come out that Blackstone has effectively defaulted on 2 other debts involving real estate portfolios. One is a $325 million loan on the Hughes Center, a 1.5 million square foot, 10-building office complex in Las Vegas, which also had more than 100,000 square feet of retail space. That loan has gone into special servicing, meaning Blackstone defaulted on it, and a third party has taken over administering the loan. And the trouble is spreading into Blackstone's residential real estate investment as well. Blackstone defaulted in February on a $270.3 million loan taken out on 11 apartment buildings it owns in Manhattan. The buildings in Chelsea, Midtown, and the Upper East Side are in high-rent areas where rents have been going up. But that wasn't enough to keep Blackstone's loan from going under. In all, Blackstone has defaulted on more than $1 billion of debt, and yet last year, its CEO, Stephen Schwarzman, took home $1.26 billion in wages and dividends. Blackstone could pay back its debtors, but its executives would rather take the money home themselves. And why not? As a financial giant, Blackstone can default on its debts and shift the problem over to people who were foolish enough to lend it money. When it comes to Blackstone, lender beware. Blackstone's problems are also spilling over into the residential real estate space. Last summer, Home Partners of America, the division of Blackstone that owns single-family homes, put a freeze on the purchase of new homes in 38 U.S. cities. Part of the problem is that during the pandemic, house prices soared, and now Blackstone and other businesses that buy up family homes have realized they're too expensive to make a profit on, especially with high interest rates. As a massive institutional investor, Blackstone gets better interest rates than the average home buyer. This allowed them to spend more per house and to outbid regular buyers. But with interest rates at their highest levels in years, even Blackstone's preferential rates aren't good enough to make new home purchases profitable in many markets. But that's just part of it. People are waking up to the harm Blackstone and other companies have done by buying up homes, and the company is facing a growing backlash. Take Sweden, for example. In 2016, Blackstone bought a controlling stake in Sweden's largest real estate company, which owns 16,000 apartments, mostly around Stockholm. It then went on to buy another 5,000 apartments and started raising rents. In 2019, the Swedish Tenants Union put out a report showing that Blackstone-owned properties were messy, dirty, and broken, as they put it. Compared to similar government-owned apartments, Blackstone's apartment looked bad. Blackstone developed a reputation for being a slumlord. Soon afterwards, Blackstone sold off its investment in Sweden and tried again in nearby Denmark. But there, people quickly became aware of Blackstone's business practices. A newly elected government passed a law that banned real estate investors from raising rent for 5 years after purchasing a property. The Danish government neutered Blackstone's business model. Yet despite all the problems plaguing Blackstone today, to hear the company tell it, everything is just fine. In fact, the company is busy putting together a new $30 billion fund that it says will take advantage of the crisis in real estate by buying up properties on the cheap. Notably, this new fund will stay away from office properties and will focus instead on logistics centers, shopping malls, laboratories, and data centers. And some observers believe this fund may not be what it claims to be, that Blackstone is actually raising this money to bail itself out of a bad situation. Its earnings report showed just how bad that situation is getting. In its numbers for the fourth quarter of 2022, Blackstone recorded a nearly 30% drop in income from real estate compared to the same quarter a year earlier. Revenues dropped from around $4.2 billion at the end of 21 to $2.9 billion at the end of 2022. Blackstone's tenants are packing up and leaving, and it looks like it can't find new tenants to take their place. The longer interest rates stay high, the harder it will be for Blackstone to pay its debts. And the longer the work-from-home era lasts, the more of its office leases will end to be replaced by nothing. Its investors are still waiting to get their money out, and its lenders are headed to court to try to get their money back. But Blackstone executives are raking in the big bucks. As long as that's the case, Blackstone has little chance of changing direction until it's too late. If you like this video, hit the like button to help us spread the word, and make sure to subscribe to our channel for the latest updates and analysis on the state of the economy today. Thanks for watching.